Welcome back. We're jumping straight in today with a really high-conviction analysis report, a fantastic contrarian take on Cipher mining, ticker CIFR. The core thesis is that Wall Street is just severely misvaluing it. They see a Bitcoin miner, but they're completely ignoring the pivot to a high-multiple AI and HPC data center play.
And that structural story, that pivot, it's the whole engine of this report, and it's built on some really excellent data.
Right.
You see things like the 198% year-over-year revenue jump, that $41 million in adjusted EBITDA. It just, it immediately lifts this analysis above all the speculative noise out there.
Sure.
The upside potential is clear, but to really make this an undeniable investment case, I think we need to solidify the foundations in, three key areas.
The analysis report really should more aggressively define and illustrate that core infrastructure change.
It really should, to, cement that new data center REIT identity.
Right. This is where you need to build what I'd call a mental firewall for the reader. The report correctly identifies the identity crisis. CIFR is moving from a miner to an AI data center.
Yep.
But the weakness is that it relies almost entirely on the financial results of the shift, that, impressive revenue jump to prove it's happening.
Instead of the nuts and bolts.
Exactly. It doesn't dedicate enough space to robustly describe the new infrastructural reality. But hold on a second. For a report like this, focused on the valuation gap, isn't getting too deep into the technical specs just noise? If revenue is up 198%, isn't that the proof?
It's proof of execution, absolutely. But it doesn't prove a premium identity.
Ah, okay.
The whole reason for arguing for a 50x to 100x multiple is that this company is fundamentally different from a legacy miner.
Right.
If the report doesn't show why it's technologically superior, the market is just going to keep valuing it like all the others. The AWS leases and HPC contracts, they're mentioned, but almost like anecdotes, not foundational pillars.
So the reader can't really visualize the new operation, the one that actually justifies that REIT-level valuation.
You got it. The claim is there, but you don't see the machinery under the hood. So my suggestion is to strengthen that logical flow. You have to inject more descriptive, even technical, context about the new compute power.
You have to show, not just tell.
Show, don't just tell that CIFR is in a completely different league. That's how you differentiate it from every other miner that's suddenly claiming to be AI adjacent.
So when we talk about this data center REIT identity, what are we really looking for? Are we saying the report needs to map out a path to an actual REIT qualification, or is it more about using those characteristics as a benchmark?
It's the benchmark, absolutely. REITs trade at high multiples because they offer density, redundancy, sticky long-term contracts.
Okay.
So, for example, instead of just saying HPC contracts exist, maybe elaborate a bit on the nature of the compute power. What are the power densities they're servicing? That is the critical metric.
That's the metric that separates the serious players from the opportunists.
100%. And how does that new 300-megawatt facility specifically cater to high-density AI processing? We just need a sentence or two on the technical moat, the cooling, the connectivity, things that go way beyond standard mining ops.
That's where the comparison becomes really powerful, right?
Exactly.
Directly comparing Cipher's operations, uptime, security, the shift to recurring revenue against established data center REITs, that solidifies the mental bridge.
And that clarity has to extend to the financials, too. When it talks about the $41 million in adjusted EBITDA going to infrastructure, give a specific detail.
Is that $41 million for specialized immersion cooling for the next-gen GPUs? That sounds very different from just, buying more ASIC chips. That clarity makes the investment case.
Okay, that makes perfect sense. So if the infrastructure pivot sets the stage, we have to talk about the valuation leap. That's the whole point.
That's the payoff.
So critique 2. The quantitative leap from a $16 fair mining valuation to that $28 to $35 target requires a much more explicit comparative bridge.
Yes, it needs to ground that massive 50 to 100x multiple expansion.
Right.
Because this is the section where the whole argument, it risks dissolving into just pure speculation if it's not anchored in market reality.
It does a good job contrasting them now. 16 for a miner, 28 plus for an AI play. It does. But the mechanism driving that jump is just presented as a dichotomy. Miner multiples are low, AI multiples are high.
On that kind of expansion, 50 to 100 times forward EBITDA, that immediately raises red flags. How does the report defend that without it just sounding like wishful thinking?
It needs calculation.
The weakness is that the analysis doesn't explicitly name comparable AI infrastructure companies, the comps, that are already trading at those multiples.
Okay.
And it doesn't provide a framework for how Cipher's financial profile, even with that amazing growth, translates into that high-end range. The reader is just asked to accept the premium.
Right. Accepting a high multiple for, say, NVIDIA is one thing. But for a company in transition, you really need to see that side-by-side comparison.
You do. If you don't introduce that market reality, you just diminish the credibility of the entire price target. So my suggestion is critical here. Introduce a brief but robust comparative valuation.
A clear calculation pathway.
Exactly. To validate that $28 to $35 target, it reinforces the whole AI premium argument using market-accepted metrics.
So what's the most effective way to do that? We can't add, 20 pages of financial modeling.
No. Keep it simple. Focus on the multiple required. Show the implied EBITDA multiple needed for CIFR to hit, say, $32. Then put that number right next to the public multiples of one or two known high-growth AI data center firms.
Okay, so if a company like Equinix trades at, 75x forward INDA, and the analysis shows CIFR only needs 60x to hit its target,
then the gap immediately justifies the thesis.
yeah, it shifts the question from can they get to 32 to why is the market only pricing them at 16 when the comp suggests 32 is totally warranted?
That is the necessary anchor. And then you have to connect the catalyst, that accelerated 300 megawatt facility, directly into the valuation model.
Because that's what Wall Street is supposedly missing.
Right. The report needs to explain how much faster that Q1 2026 deployment accelerates the recurring revenue needed to justify the price target.
So you turn a general complaint, Wall Street is wrong, into a very specific quantitative error. Wall Street's timing is off and it's costing the share price X dollars.
Precisely. Make the analyst divergence highly visible and specific.
That really strengthens the financial architecture. Okay, let's turn to the overall flow where the conviction meets the execution. Point 3. The report's structure abruptly shifts from a long-term case to a very short-term tactical trade setup.
And that creates a potential disconnect. Yeah, this is a classic case of cognitive dissonance being created by the structure itself.
The core argument is all about the structural multi-quarter transition. You're talking about a big, slow, powerful fundamental machine.
The Q1 2026 target, the massive facility.
Right. But then the technical analysis section immediately pivots to this high-urgency short-term trade with a very tight stop-loss under 1550.
Yeah, that juxtaposition it's confusing. If the fundamentals are truly a generational trade with massive upside, then advising such a tight stop-loss suggests fragility.
Or worse, or a lack of real conviction in the main argument. The reader subconsciously starts to question it.
So we have to smooth that transition. The suggestion here is to better integrate the technicals into the fundamentals. Position the current price action, that 1620 to 1650 zone, as a strategic accumulation phase.
Not just a breakout or breakdown level.
Exactly. It needs to be aligned with the long-term structural timeline.
In other words, the price chart isn't just a pattern, it's a reflection of the fundamental floor.
You got it. So for a concrete example, reframe that technical section. Explicitly label that $16 level as the fundamental floor established by the existing profitable business.
The $41 million in adjusted EBITDA?
Right. That level isn't just some technical line in the sand. It has real fundamental weight behind it.
And we could probably do the same thing with the technical indicators, right? The report mentions the RSI resetting, cooling off.
Perfect opportunity. Modify that discussion. Explicitly tie the RSI cooling off to the accumulation window needed before the market starts pricing in that Q1 2026 facility.
So the technical setup becomes a function of the fundamental catalyst timeline. That improves coherence.
Tremendously.
And if this is really a generational trade, which implies patience, that tight stop loss just fundamentally contradicts the message. It feels too risk-averse for the conviction being asserted.
It creates a mixed message that just undermines the whole thesis. When you're talking about these kinds of volatile, contrarian plays, you have to preach patience. So the advice could, soften the urgency of that stop loss or maybe offer an alternative.
Like a scaling-in strategy?
A scaling-in strategy would be perfect. It takes advantage of volatility to build a position, which aligns the trading tactics with the long-term conviction.
That's a powerful set of refinements. So we started with a very strong analysis report. It correctly identifies a massive, contrarian opportunity in CIFR's pivot and argues Wall Street is just plain wrong.